Dear members, dear friends, dear participants, welcome to ATEL Summer Conference. I'm really pleased to host the first ATEL e-conference at HSBC Luxembourg, one of our ATEL sponsors for this event. I'm even more pleased to welcome you today, knowing the long lockdown period we have all faced. The health crisis seems to be over. However, we are not yet back to normal and won't be maybe soon. It is the reason why, with our partner, 360 Cross Media, and the board of ATEL, we have decided to organize the first e-conference. In the coming months, we will certainly continue to live broadcasting our events, as number of usual participants won't be able to attend the conferences. We plan to have mixed conferences with physical presence on one end and digital attendees via the live broadcasting. And even more, with video people could watch after the event. It is our first e-conference, and we will do our best, given these exceptional circumstances, to make it interesting and interactive. Thanks for joining us today, and I wish you all a good conference and the best for the coming weeks back to the offices. I wanted to give a special thanks to our 4 sponsors who help us designing this event: Arendt, HSBC, PwC, and TIS. Thanks a lot for your support and the trust in ATEL. Today we have a very diversified and comprehensive program. In the first part, Philip Foster from PwC will talk about the accounting impact of COVID crisis on Treasury activities, and he will address top priorities in this recovery phase. Then David Bloom from HSBC will talk about the FX markets and explain current situation and what we should expect in the coming months. After David, Holger Zöner from HSBC will talk about risk management, again in light of the current crisis. After this presentation, Jörg Wimmer from TIS will make a presentation of corporate payments and cash flow and how to increase efficiency and further digitalize activities. Eventually, Alain Goebel and Danny Beaton from Arendt will explain the recent OECD guidance on BEPS and impact for treasurers. It is particularly useful to accurately assess transfer pricing. For those who want to network, after the conference, we have 2 separate sessions to brainstorm on hot topics in Treasury. The first session on post-COVID-19 impact and outsourcing, hosted by myself and by PwC, and the second session will be on substance, hosted by Gaëtan Dumont with HSBC and Arendt again. I wish you all a great e-conference, and I'm looking forward to seeing you soon to our events, if possible, physically. Enjoy the conference, and now let's start.
And I would like to welcome Nicolas Poli from HSBC. Thanks again to HSBC to host this conference.
Thank you very much, François, and let me add my welcome to that of François. So welcome to the ATEL Summer Conference 2020. It was our pleasure to host it. We were going to obviously do that live here in our offices. It's a beautiful day. We have a terrace. We're going to welcome everyone here for drinks later on, for the networking, but obviously COVID had other plans for us in store for 2020. So we innovated, we went digital, and we've all gone for the e-conference, which we hope to make as interactive and networking as possible. So thank you for that. I think many of us have had to adjust to COVID and to innovate and to digitize in many respects. You know, e-conference is one of them. As many of you know, we're doing it on Zoom today. That is another thing that we as an organization had to roll out rapidly to enable over 200,000 employees worldwide to be able to work from home, and over 97% of our employees here in Luxembourg to work from home. We've also innovated in other ways, which I'm sure many have done. We've introduced digital signatures through our live sign, which has impacted our ability to onboard people remotely and quickly. We've gone from days to hours in many cases. And we've also introduced global disbursements, which is present in 170 countries, 135 currencies, including PayPal. So I think like many, we've had to really adapt to the situation and make the best of it. And it reminds me of a little joke I'm sure many of you have seen circulating on the internet. It's a multiple choice question. It says, who is responsible in your organization for digital transformation? Is it the CEO, the CTO, the head of digital, or COVID? And I think we all know the answer to that. And I don't know why it's so funny, because it's the CEO, of course. Welcome again. A quick request, if I may. We've got the Euromoney Survey 2020 launching next week. Thank you to everyone's support. HSBC retained the title of Best Global Cash Management Bank for Corporates for the 8th consecutive year. We'd be very, very grateful if you could just participate again this year and rate our performance on that. I think we'll be sending details later. So we have a great lineup today. Francois has already introduced a bit, including our economic rockstar, David Bloom, from HSBC. We hope you enjoy it. I want to thank Francois, PwC, and everyone once again for putting up this event that we are very grateful to host here. I hope you enjoy it, and to Francois.
Thanks, Nicolas, for this introduction and for welcoming us today. So let's start with the first topic. So the first topic, I would like to invite Philippe Foster from PwC to come and join me on stage. So we will talk about, and Philippe will explain, the consequences of the COVID crisis for corporate treasurers, but with a special angle. So we will talk about the impact on accounting. So I think it's quite interesting to know also that being so close to the closing of mid-year 2020, it's interesting to consider also the potential accounting impact of the COVID crisis.
Welcome everybody to that session on COVID-19 and the impact on accounting. I do hope that everybody's safe at home right now. I'm really happy to use the technology to be able to share with you some insight and some stuff we've seen from our clients. I will be here with Francois, for once I'm introducing you, by the way, to discuss three things today. So impact on the treasurer agenda, impact on the reporting, because as you know, June closing is coming quite quickly. And then we're gonna discuss a bit about lessons learned that we can share with you as of today. So let's start with the beginning. As you can see on that slide, we've just gathered the result of our 2017 global survey, 2019 survey, and we tried to estimate what was the priority for you guys as of today, so at least at the beginning of the pandemic. So very interestingly, cash flow forecasting is at the top of the list in 2017, it's on top of the list at 2019, and I think it's still on top of the list as of today. Funding have really rocketed in 19, and I think it's still a very important topic today. Currency risk, obviously, and the capital structures. So putting all of these as of today with the pandemic impact, I think we can say that the pandemic have a kind of strengthening the agenda of the treasurer. Is obviously everything about cash, but we can say that liquidity management is really priority number one, or has been priority number one. And then the funding, working capital and trade finance. One more time, how do you go for short-term funding, for instance? And then FX and credit risk management. Francois, maybe you have a first word to say on that?
I totally confirm your ranking, in my opinion, and according to the last survey we did for EACT, for ATEL, it seemed that the ranking of the 19th survey is still accurate, and it's quite interesting because the four, let's say, elements are quite interconnected. Liquidity is quite important. Liquidity could come from banks, from capital market, or injection of new equity. We saw a lot of increase of equity. So cash management is quite important, or to make sure that you collect faster money. You know that a lot of suppliers are complaining that the delay of payment are longer and longer. So funding liquidity is quite interconnected. Working capital also, because it's important to redefine, to make sure that, because you have two, let's say, uncertain issue, you don't know if you will receive the amount you are expecting and how much you will receive, and then you don't know when you will receive that. And FX, it's also connected because, of course, you can receive and pay in different currencies. And risk management, counterparty risk, it's also a big risk this day, because it's not only a risk for the financial institution like during the last financial crisis, but more the counterparty risk of your, let's say, customers. And all in, it drives us to the digitalization of the financial function, and I think that it's an opportunity to go a step further into the digitalization. But maybe an issue for you, Philippe. We are close to the end of June, so closing is coming. What are the, let's say, accounting impact of this COVID crisis?
Well, indeed, Francois, we're closing to June 30, and question on accounting and impact on the reporting will really come on the table. So I think, as you can see on the slides, there are several topics. Let's start with the accounting impact from your liquidity management. And the first one is very easy, but it's something we need to keep in mind, is about your cash equivalent, because everybody will be happy to show that you still have some amount of cash on your balance sheet. Now, if some of you have invested, for instance, in investment funds, you know that the definition of cash equivalent is it should be a financial asset, a highly liquid investment, readily convertible into a known amount of cash, and subject to no or insignificant change in fair value. I think everybody will recognize that we have seen tensions and an increased volatility in financial markets these past months. So considering this, what about the historical volatility of your investment? You know that in order to be able to classify it as a cash equivalent, you have some threshold to meet. Just pay attention, you're still under that threshold, otherwise you will have to present it as a short-term investment rather than as cash equivalent. Another one, is the funding. Obviously, there is no big deal when you go to the bank and ask for new borrowing, but issues might come, or at least challenges, when you renegotiate your financing. We're going to talk about it in a few minutes. Another point is the reverse factoring, and I think, Francois, you mentioned that some suppliers were a bit angry with the delay of payment. I have to share something with you. I was really pleased to receive calls, I think it was 2-3 weeks ago, from clients who were asking me to implement reverse factoring, not so much to help them in their financing, but they were big corporates and they wanted to help their strategic suppliers and somehow other suppliers if possible. So how does it work? Well, in a nutshell, reverse factoring is you have some trade payable to pay. Rather than waiting for the last day, you ask a bank to pay on your behalf, and you will repay the bank later on. So key question, obviously, accounting-wise for you is, do you still have some trade payables, or are you facing now a new bank borrowing? Well, there is indicators to meet. Happy to discuss this with you if some of you have questions about that. But obviously, the impact or the main consequence for you would be to have new borrowing and then to break some covenants or to change a bit KPIs you might have on your financing. So still in trade finance, I think another tool which is often used is factoring arrangements. And this is just working the other way around. Well, in this case, you are waiting for your receivables to be paid. If you need cash directly, well, you can transfer those receivables to the bank and receive the cash directly, minus premium or fees or whatever. And then the key question of the accounting debate is always, once you've received the cash, can you derecognize your receivable? Which means now you have the cash, you have no more receivable, end of the story. Or you still have your receivable, you have the cash, but you have an additional liability because maybe you will have to repay the bank if your counterparty is going to default. So this one is a bit more technical, and I'm inviting you, sorry, to look at the slide where I just summarize a bit, what do we have to pay attention to when we're analyzing a factoring arrangement. So in a nutshell, if you transfer no risk, no rewards, well, obviously you cannot say you don't have any more the receivable on your balance sheet. If you have transferred every risk and every rewards, there is no reason for you to keep it on your balance sheet. So in between, you have some tricky situations, but to answer to that question and to deal with it, we usually look at 4 types of risks. First one is the credit risk. This one should be totally or quasi-totally transferred. Late payment risk. This one should be transferred. It can be kept, but if kept, obviously you need to cap it because you can't say that you keep a late payment risk for 2 million days. Obviously, this is somehow a default. Now, an important point on this one is I think the crisis have increased the weight people will put on that late payment risk. Before the crisis, if you were accepting 30 days, 60 days, or whatever, now you know that your counterparties might be paying later on. So this risk is becoming higher. Yeah. Does it trigger a change in your conclusion or not? Really needs to be analyzed.
Yeah.
Yeah. Another risk, which is often mentioned, is the dilution risk, which, to make it simple, is the client will not pay, not because he's going to default or because it's too late, it's just because he's unhappy by the service you provided or the goods you've transferred. So this one, this risk can be kept. It will not preclude the recognition, but it just needs to really be defined in the contract. And then you have the very interesting one in those days, which is the force majeure risk. And this one, usually we've said, you can keep it because the probability is very weak. Well, does the force majeure include pandemic or not? And if yes, what's the impact? So I think there is two kinds of situations you may be facing. Either you are now entering in a new factoring arrangement, and then you will go through those risks and say, well, can I still recognize my financial assets, my receivable? Yes or no. And you may have as well a situation where you already have an arrangement in place, receivable have been derecognized, but now you have to analyze again those clauses, because if you have something about force majeure and pandemic is not in there, then you might have to recognize a new liability because you know you will have to repay something. So this can have somehow a huge impact on the balance sheet, I think. The next one is, as I mentioned, regarding the funding. So having a new funding is okay, no big deal. Renegotiating a funding is more challenging accounting-wise. The first question to ask is, are you doing this with the same counterparty or not? If not, clearly, you derecognize the initial borrowing, you recognize the new one, you have an impact in P&L. If you're doing your renegotiation with the same counterparty, then you need to go to the famous 10% test, which somehow is there to help you to say, okay, is the modification substantive or not? If it's a minor modification, you can say, okay, I'm just modifying my liability, I continue with this one. If it's a substantive one, then you need to derecognize one more time and recognize a new one. Accounting-wise, the difference is, if you have a substantive modification, you derecognize and you recognize the new liability, fair value, fine. If it's a modification, then you will have to compute the net present value of all new future cash flows discounted with the initial effective interest rate. And then you will still have a day one P&L impact. So questions we receive on this is, what do we do with the moratorium? What do we do with the renegotiation of covenants? And then something which is a bit related is, what happens if we have a breach of covenants? So moratorium and renegotiation is included in the test. You need to estimate the new cash flows, consider whether or not you are within the 10%, and then deal with the P&L impact. Breach of covenants is another story, because in this case, your borrowing is becoming directly current. You might have to pay in weeks, months, days. So this is really, really...
But we can expect a certain tolerance given the exceptional circumstances.
Yeah, well, I think the standard is not giving any tolerance in there. And that's the key issue is, if the day before your closing, you breach your covenant and you had no time to go for the grace period and to have the agreement signed, somehow you still have to present everything as a current. Now, obviously, everybody will be aware that you will close your accounts. The week later, you will receive the agreements, but you still have to present it as a current liability. Any information is good to put in the notes. I think we will talk about
negotiation could take a while, so
yeah,
it can be in the middle of the negotiation. Yeah,
exactly. So there is some important point to keep in mind. Another topic that is often coming on the table as well is obviously the expected credit loss. As you know, IFRS 9 is requiring you to account for expected loss in the future. This is based on forward-looking information. So now I think on this one you have several points to consider. The first one is, well, forward-looking information. Who knows what will be the economy tomorrow? I think that's a very, very strong and difficult question. And then the second one is, what do you do with your provision matrix, right? So with your provision matrix, I think the first thing is maybe to review the segmentation of your portfolio of receivable and maybe to go in a step further, to be a bit more granular. For instance, if you have some client in the logistics, you might say, okay, logistics is one bucket somehow, but maybe in there I got airlines, to take an easy example, and exactly, and other kind of transportation. We all know that airline is really, really suffering for the pandemic, so this one might suffer more from the credit risk than the other. Obviously, pay attention to government measures as well, because we have a lot of bad news, or at least items that would trigger an increase in credit risk, but your counterparties may as well benefit from some government measures. So this might, help to decrease a bit somehow the increase in credit risk. Forward-looking information, as we mentioned, this one is key, and I think that the best way maybe is just to add an additional scenarios. IFRS 9 is requiring you to consider several scenarios and to put some weighting to see which one is most probable and whatever. Adding a downside scenario to consider the effect of the pandemic is somehow an easy solution to implement. And one more time, if you have credit insurance or other kind of warranty, please review the clause and make sure that pandemic is included, because this is not always the case. So I would say that that's a bit it. Maybe you can change as well the definition of your default or definition of significant increase in credit risk, because usually people tend to take the one presented as standard, which is 30 days past due is an increase in the level of risk, 90 days is a default.
A bit too short. Yeah.
It might be a bit too short due to current conditions, so maybe it's time to review it. If you change this, it's a prospective change, so no need to change your comparative. And something very, very key here is the disclosure, because really nobody knows where we're going. So disclosing the hypothesis and assumptions you've taken, maybe adding some stress test on that, is something which is really expected by regulators. A last topic, which I would say last but not least, is hedge accounting. I've prepared a very simplistic slide here just to put on the scheme what's going on. I think you can say before the pandemic, you had your budget, you have your forecast, you were expecting some transaction at some dates. You take your derivative to offset the position. Everybody is happy, I would say, or everything is going well. And then the crisis and the pandemic is going on, and your transactions are delayed, cancelled, or decreased in volume. So what are you doing with your derivative? Exactly. You have that question of overhedge, but not only. So if you consider FX risk, commodity risk, and interest rate risk, you will be facing somehow different challenges. I think for FX and commodity risk, we can talk about highly probable criteria, right? You were expecting that transaction, but how can you say it's still highly probable? This might be a bit more difficult to defend. Exactly. The overhedges you were mentioning, because you've taken some derivative for whatever 1 million, you only have 500K of transactions which have been somehow secured. What are you doing? And when your transactions are not anymore highly probable, or when your transactions are delayed, you have to recycle the accumulated fair value you have in OCI. So I think the answer is yes, and this might trigger huge impact on the P&L. I think as an example, it have been announced in the public, but I think Air France have announced close to 500 million of loss due to that specific issues. So it can be significant. Timing difference, your transactions are delayed, your derivative is not, if not roll forwarded. So this creates ineffectiveness which needs to be computed and recorded in the P&L. Rollover strategies, I do hope that you have anticipated such rollover in your documentation, because you know that in hedge accounting, the starting point is really how you document your hedge. And for interest rate risk, well, what do you do with the payment holidays you've been benefiting from? Right? This is a change in the cash flow, your swap is still there, so one more time, you might have ineffectiveness. For those of you who go and negotiated new loans, probably you will have a floor in your variable borrowing, which means it can't go below zero, while on your derivative, it can go below zero. So there, you have some stuff to consider as well. And not COVID-related, but still the cherry on the cake, IBOR reform is still on the agenda. There were no delay in there. So this will as well have an impact on your hedge accounting. So this is, or those are the issues I wanted to share with you, because I think it will be a redundant topic for closing, either now or for December closing, for those of you who do not have half-year reporting. Any question is really welcome. Please feel free to join me later on in the session, or to contact me if you want to discuss your accounting. And now I think it's maybe time to, look a bit at the crisis, which I hope we can say is behind us, and say what lessons can we learn from that. So, François, maybe you want to say something about that?
Yeah, but at least we can draw some first conclusion, or at least some
we've identified a few issues we could have, let's say, better prepared. We mentioned liquidity management and funding. It was top on the list, as well as bank relationship. And we realized a lot of companies were not secured with committed credit facilities. Although a third of the companies surveyed by ATEL said that they were not facing problems with liquidities, we know that the two other third were facing some problems, and sometimes because they were not, let's say, committed. And so it has a value to pay a premium to get a security. Also, having a committed credit facilities doesn't mean that you cannot be triggered by the covenant, as we mentioned, because if you breach a covenant, you have a cure period, but the situation could be, let's say, longer than 3 months of difficulty. So I've also noticed that BCPs are in place often, but we saw that the first weeks of Treasury from home were chaotic, and so BCP should be implemented, documented, and tested. It's not always the case. Forecasting, big issue. Everybody, all the members were complaining about the forecasting. And what was also quite let's say, not amazing, but it's surprising, it's the type of question from the C-level regarding the stress testing, sensitivity analysis. And so a lot of corporate treasurers were busy in producing on Excel, unfortunately, a lot of reports, urgent reports that take a lot of time, a lot of energy, with a lot of risk of errors, of course, and they were not prepared for that. So they lost a lot of time because of the lack of the tools. And so it comes to the conclusion. So first, you need to be better prepared, but you can also go for more digitalization of your finance function. My first impression is that a lot of companies have transformed their business into the digital area, but for the finance, it was a bit behind, and now we need to go and to move to more digitalization to get more automation of processes, to secure the processes, to reinforce your internal control, and to be more efficient, to, let's say, get rid of some operational tasks, to move for more analytic or strategic functions.
Yeah, there are some few points where I would like to touch base on it. I think you mentioned that a lot of people are saying forecast is really bad or it takes too much time. And I have to say, I often hear people saying, you know, it's so wrong. I do not see the point of doing it. But I think it's still a good way, at least, to anticipate where your falls in cash can be, even if it's not totally right. Even if you have no tool, I think you can start on Excel. Pareto is really a good friend in there. It's the 20-80 rules, but start with at least your main and principal cash flows, inflows, outflows, and see what's in the impact. Everybody has not yet the adequate equipment to have AI or whatever, which is very helpful, by the way. But I do think that it's still worth doing a forecast exercise. You've mentioned digitalization, and I think, yes, it's true, but it's only half of the story, I would say. And as we said in our 2019 survey, it takes two to tango. So going on digital is fine, but don't forget your talents. And I think you need to really work on both sides to have a winning team somehow.
Yeah, we also notice a lack of resources. A lot of members are complaining about the lack of resources in their treasury organization, especially with the COVID. We are fragmented. The team are not communicating to each other as they did in the past. So it's really important to go a step further into the automation, to free some time up, to make sure that you can also concentrate on other tasks and make sure that the treasury will be properly run. But the good news is also an opportunity, and the good news also for corporate treasurers, they will be, as in 2008 after the financial crisis, let's say, brought forward and in the light, because treasury, it's the most important job in finance, I guess.
Yeah, and I think the fact that you're receiving probably on a daily basis questions from your C-level, it's really a good time as well to educate them and to tell them, well, look, this is the value Treasury is bringing. This is what we do. This is how we can help the business. And doing so, I think it can help you at least to negotiate some budget to go on digitization and really show them that the idea is to be more resilient and to avoid any issues in the future. In a few words, I understand that somehow cash is king. We all know that. I think data is key as well.
Yeah.
Visibility is king as well. We have a lot of key or king topic to deal with. I mean, digitization will help, of course, to deal with everything, but maybe some priority for, you know, if we imagine a corporate which has a very basic treasury who's facing difficulties, still surviving, and now they said, okay, we're restarting, you know, what could we do first? Any idea on that?
Priorities to me, it's to keep consolidating your bank relationship. We saw the value of solid bank relationship, not to be over concentrated, not to be diluted and fragmented. So you need to have a few key bank partners depending on the size of your funding. It's quite important. And we see the value of the relationship on the long run, because when it's difficult to get credit, it's important to, let's say, work also on faith and trust. So that's the first recommendation. The second thing is to try to get the tool to anticipate, to have a more proactive approach of Treasury rather than to be reactive, because Treasury is, let's say, acting as accounting afterwards when we close. And so what the C-level is expecting as CFO is to have more, let's say, accurate, immediate answers. And it's why these days, and something that you at PwC have really brought forward, it's the era of Treasury on demand. So we would like to have everything real time and to be faster in getting the information. So that, for me, a key lesson we should take from this crisis. So we should revamp and revisit our processes. But again, it's an opportunity, if we are ready to invest a bit in time and technology, to have a more efficient treasury management.
Okay.
Any conclusion words or comments?
Yeah, well, I think we touched base a bit on everything. Happy to answer any questions during the session at 7 p.m. or in the coming days if you want to reach out. Really happy to connect with you guys. Yeah. And what can I say is stay safe and do enjoy the restart, if I can say so. Thank you, François.
Thank you very much for your attention.
Thank you all for watching.
And now let's move to the next speaker. I would like to introduce you, Jörg Wimmer from TIS. We will talk about the next step for digitalization of your businesses. And Jörg will talk more about Payment Factory and the way of outsourcing your payment if you want. So Jörg, the floor is yours.
Thank you, François. Happy to be here. Good afternoon to everybody. Let me share my screen. And I hope that you can hear me. If this is not the case, let me know in the chat. My name is Jörg Wimmer. I should go on full screen. Maybe that helps. Here we go. My name is Jörg Wimmer. I'm co-founder and CEO of TIS. I started this business 10 years ago. The problems which we solve today, these were my problems in my former life. So I spent 8 years as senior vice president and head of global treasury working for SAP. So together with the treasury team, I was responsible for all treasury activities, including capital market topics, risk management, but last but not least, payments were on my desk as well. This created some sleepless nights. So we created this company in 2010. And once again, feel free to give comments or ask questions in the chat during my presentation. So company is 10 years old. We focus on payments. Company is still founder-led. I work, as I said, in treasury. My colleague, I have no clue how to do software programming. That's the reason why I asked Errol Bozak to join. He's the co-founder. We have 150 employees in 6 locations, including offices in Boston, since 2018. This is a multi-tenant cloud platform. We started early with cloud, very early. Payments in the cloud environment, this was a risky bet 10 years ago. These days it's standard. No investor is willing to invest in on-premise anymore. No customer wants on-premise, so cloud is the trend. And it's great to see that our vision, which we had 10 years ago, became a reality. So we started from scratch, and now we have 150 colleagues and 30% market share in the German blue chip index DAX. In numbers, yeah, 50,000 bank accounts, which we manage on behalf of our clients, thousands of users, 100,000 of counterparties, so companies which were paid through our platform. Huge volume which runs through our platform, 2,698 billion total payment volume. We are connected to 10,000 banks in 80 countries, 600 payment formats. And yes, we have some nice awards, which you see here on that slide. We focus on payments, as I said, only. And here we connect systems to ERP systems to the banks. And that's the reason why we are SAP certified for our connectivity. It's always important to make a very good first impression, right? The treasurers, they all know each other. And if you have good customers on stage as evangelists, this helps a lot to kick in that upward spiral, which is the case right now. We have customers in different industries and excellent reputation in the market. Please feel free to ask our customers. They are all referenceable. So our vision is to become the global payment platform for corporates. 3 colleagues on C-level, Errol and myself, plus Erik, he's the COO. We have a great customer base. Good news here in the payment process. It's pretty much the same process in different, despite the industry. So we can scale across industries. We are industry agnostic. As you can see here, we have insurance companies, logistic companies, retailer. We have even banks as customer, and so on and so forth. So we focus on payments, and the payment process is pretty similar. So these were some of the challenges which I had in my former life, and which we see on a daily basis when we speak to customers. Payment challenges. Okay, right now it's cash is king. We heard that before. Cash flow is queen, maybe. Lack of transparency with regards to cash positions and cash flow. That's always a challenge. We see that with some companies that they just recently started to invest. And this is probably a mistake and a bit too late. When I was a treasurer during the financial crisis, 2008, the CFO knocked on my door almost on a daily basis. How much cash do we really have, and how much cash do we have in a certain bank clearing system? Do we have a bulk risk? Do we stick to the limits which we have for these banks? So lack of transparency is not only a risk for the company, but also a risk for your career. Fraud risk. BEC fraud is picking up. Everybody's working from home, so it's difficult to leverage e-banking tools from home when they are locally installed on laptops in the office. So compliance risk. What we strongly suggest is to establish a standardized process, a secure end-to-end process to establish adequate governance processes to cope with those compliance risk and payment fraud risk. Last but not least, you have high workload due to manual processes, file uploads, file downloads. And when you have manual processes, this is error prone. You typically don't have real-time reporting if a lot of manual Excel jogging is involved. And these are some challenges. At the end, it's also about integration. So how do you connect your banks to your systems, to your ERP or to your treasury systems? So on-premise is probably not a good idea. On-premise means why should you reinvent the wheel over, or why should each and every customer reinvent the wheel over and over again, connecting your on-premise ERP through whatever middleware components, through IT projects with your bank. So from a treasurer perspective, in my former life working as a treasurer, I had very ambitious goals with regards to process efficiency. And when I had to ask IT to support, I had to run through those internal fights for IT resources. So best case is, as a treasurer, from a treasurer perspective, you are independent from your IT teams, and that's the case with software as a service. I spoke about the cloud and lack of transparency already. So how can TIS help? And where is the 3x return on invest, which we promised in the title of this presentation? This will come in a second. So that's the typical starting point, which we see with our customers. So there is very often headquarters involved, treasury team, accounts receivable, accounts payable happens not only in headquarters, but in the shared services and the subsidiaries as well. And then you have different systems. Probably you acquired other companies and you acquired other systems. There are treasury systems, HR systems, other legacy systems producing payment files, and for sure, there are your ERP systems, which you need to leverage to, at the end, pay your suppliers, settle your treasury deals, and pay your employees. And without using TIS, and this is the root cause of the problem, or one pieces of the root cause, those different e-banking tools, you don't scale with e-banking tools. Those e-banking tools are typically not multi-bank enabled. So you need to run around with the bag of secure ID tokens, which you need to use to log into your different portals. Maybe you have treasury systems next to it, and these painful in-house projects, which I have described already, right? And nobody, in a perfect world, there is only one system, and this customer or the treasurer needs to connect to one bank, but nobody, and this is the perfect world, nobody accepts bulk risk, nobody wants to trade or wants to execute payments with one bank or with one clearing system only, so you diversify risk. And the better you are diversified, the higher the complexity on the system side. So it's obvious this is an M2N relationship, many systems and many banks, and this simply does not scale. Very high cost, very high risk, and the lack of transparency. When you have 20 ERP systems, how do you want to calculate your daily liquidity position? You need to wait for your accountants that they do the open item reconciliation. And this has nothing to do with real time. So when you change the setup, when you migrate from this old world into the new world, you significantly decrease the level of friction, you decrease the IT costs, and you save banking fees. I will come to that in a second. Why is that? Yeah, because in that new world with TIS connects all your systems with all your banks. We are connected through different channels, host-to-host, EBIX, Swift channels. We are Swift partner as well. So we are connected through different channels with these 10,000 banks. And the trick here is there are bank and country specific flavors in the market. So different payment formats, that's the bank language you need to speak. And this comes as a service. This is part of our service offering. We connect all the systems, convert your payment file, which you create into a bank specific, maybe bank and country specific format, which you need to access the local clearing system. So good news, you keep your banking landscape as it is, you keep your system landscape as it is, but you replace your e-banking tools, your IT projects, what TRS as your single point of contact and your single source of truth. So we clean up and standardize your process. And this leads to significant return on invest. Back to this return on invest calculation. And yes, needless to say, please give us a call. We can analyze your situation, the as-is situation, analyze your total cost, and can compare it with your future state, which we can achieve together. This should lead to a 3x return on invest per year. And first level of savings is the decrease of frictions. It's an end-to-end process. So from your secure ERP system through our platform to your bank, end-to-end process, no manual uploads, downloads anymore. 4i principle is embedded in our workflows. This at the end saves time for manual processing. Think about the painful bank statement collection, upload, download of bank statements before your accountants can start working in the morning. So long story short, decrease level of friction, decrease the time you need to invest for manual processing, and automate and standardize. Second layer of savings is the decrease of IT costs. Why is that? Well, bank specific tools, those portals, they need to be maintained by your IT teams. Sometimes you need to maintain those with regards to different users in the portals, but your IT teams, they need to deliver software updates for those tools. You need to maintain probably middleware components. You need to probably configure your payment media workbench in SAP environment, which means you need to configure the formats. That's not necessary anymore. Outsource this to TRS, decrease your IT costs. This makes you more flexible and much faster because those banks are connected. We know all those formats, we know all the systems, and don't reinvent the wheel. Simply outsource complexity to us. And last but not least, you will be able to save bank fees. Why is this? Because we are a multi-bank enabled platform. So you have the full flexibility to change different communication channels which exist with the different banks. So in the old world, there is a kind of lock-in effect when you have when your system is connected, directly connected, your ERP system through IT project directly connected to a bank, it's very difficult to walk away. Obviously, this hurts your negotiation position. In a multi-bank enabled setup, like in our world, it's very easy to reroute payments and to simply ramp up new channels which are available for all of our customers on our platform. So this helps you in your negotiation, by the way, next to the fact that you have full visibility and control with regards to the share of wallet which you allocate to certain banks, because this comes, we deliver certain dashboards where you can carefully analyze the total volume per bank running through those different pipes. And once again, this leads at the end to a 3 times ROI. And yes, the service fee is included in that ROI calculation. Once again, a proposal is outsource complexity to TIS. We do this since 10 years. This is available very fast. If you want to learn more, feel free to give me a call. Happy to guide you through this business case.
Thank you, Jörg. And now I would like to move to the next topic, and I will introduce you Alain Goebel and Danny Beaton from Arendt, and we will talk about BEPS and the new OECD guidance. It's quite interesting to know how to best, let's say, caliber your transfer pricing methods. So, guys, the floor is yours.
On behalf of Danny and myself, I wish you a very warm welcome to our presentation. We have the pleasure today to take you to a couple of slides over transfer pricing issues that we believe are important nowadays for treasurers. As you may know, Danny is our senior transfer pricing economist at Arendt, and I myself, Alain, I'm a tax and transfer pricing partner at Arendt. And both of us are part of our transfer pricing team at Arendt, where we have 7 full-time specialists that are dedicated to transfer pricing issues. Since 2011, we focus with a very strong focus on financial services, but basically we handle all kinds of transfer pricing issues. So today, our topic is transfer pricing for treasurers. What is new? What is important? Of course, 2 topics are crucial in this respect. The first one being the adjustment that might be necessary because of the COVID crisis, and the second being the new transfer pricing guidance on financial transactions that have been introduced by the OECD in February this year. And afterwards, we try to summarize our recommendations from a practical perspective for you. So, regarding the context and the objectives of this presentation, of course, everybody knows that the COVID crisis has disastrous effects on the economy. This, of course, will also impact significantly transfer pricing in multinationals. And so it is indeed a big issue for treasurers. The OECD has commenced a project to prepare guidance on how to deal with adjustments that become necessary because of the COVID crisis. And taxpayers may have to anticipate that they will need to change their transfer pricing policies now in an arm's length way. On top of that, the second issue is that the OECD has published on 11th of February this year new guidance on financial transactions, and so the transfer pricing principles that were applicable so far are unfortunately significantly impacted by this new guidance. So the presentation here, the objective is to give you a better feeling of those aspects and of what will be necessary, in our view, for treasurers to adjust. And I hand over to Danny, who will give you more technical insight.
Thank you, Alain. So, as usual, the OECD has coordinating the international response on transfer pricing matters for the crisis. It's done that by asking its Working Party 6, which deals with new transfer pricing guidance, to survey the market and report back, probably now in the first quarter of next year. This document, which it will produce, is designed to be a consensus document, which means that all jurisdictions should respect it and adopt it, which is good. But it probably will tend to mean, as with the Chapter 9 on business restructurings, that it is based almost entirely on what is already in the guidelines. So we can expect it to draw heavily on two sets of existing guidance. One is on options realistically available. That is, options for both parties to continue with or to change their transfer pricing agreements with each other. And guidance in the transfer pricing guidelines already on business restructurings if the parties decide that they have to retrench perhaps and centralize activities or abandon them altogether. And then perhaps compensation could be due. We're all invited to send problems, concerns, issues, potential solutions to the drafting group, and we've included the address at the bottom of the slide. So how might we feel? Well, we have to act quickly before the new guidance that we should change the transfer pricing policies in response to the crisis. The obvious problem is generally a shortage of profit. Another for treasuries is a shortage of cash and liquidity. So profit margins are falling across a whole group of companies. We see independent companies reducing their prices and margins with their suppliers and customers. Should we stay exactly with the policies that we have now with our related parties, or should we change them? We have limited risk manufacturers and distributors. Should we respect those agreements? And the answer is, what would third parties do? What are they doing? If we can observe what they are doing, or what we are doing with third parties, perhaps we should copy that. If not, we have to consider, are options realistically available for both parties? In the interest of maintaining a long-term relationship with our supplier or customer, should we share the financial pain with them, even if our agreement says that we shouldn't? If we do feel that we should terminate an agreement and try to source business elsewhere, there might be an early termination compensation. If we feel that we should simply get out of that business and perhaps transfer the customers to another part of the business, then there could be a transfer of something of value requiring the calculation of compensation according to the OECD guidelines. And turning to the next slide, it will be vital to prepare quickly some transfer pricing record of what we're doing and why, including why the changes are needed, why the specific changes that we are making are the right ones, and why our valuations are correct. We will need to document our consideration of what third parties are doing, what we are doing with third parties, if not what the other options were for the parties. And it doesn't have to be an extensive document, just something very brief. Of course, we may go back to the old policies in 6 months' time. This may be a temporary measure. If we are having now to change our benchmarks for prices and margins, if we look at our databases, they're 12 to 18 months out of date. They don't tell us what is appropriate to a crisis situation. The challenge then is to select comparables which could still be useful for the current situation. For example, ones that have similar ratios of fixed to variable costs and would have to respond to a fall in sales in the same way that we may have to. And to make adjustments based on the relationship between their profit margins and their sales. And something, the last point, which we know the Luxembourg Tax Administration has picked up on in controversy matters, giving more recognition to local factors. The impact of the crisis is different according to the kinds of business in your jurisdiction. The government support and government restrictions on business are different. And hence, the expected change in transfer pricing arrangements should be different for each jurisdiction. Now, if we go on to the next slide, it's specifically about the Treasury response to the crisis. For the Treasurer, we find that we need to focus more on cash and working capital, and we have to look more to external sources. We may have to give more related party loans or guarantees for external borrowing. We may encourage our parties to defer the collection of interest payments or repayments of principal. If we're involved in tolling debt factoring, if we're not involved in debt factoring, perhaps we want to start considering advance payments from those who still have cash to those who need a lot of it. And perhaps we should change our transfer pricing policies for new market conditions. This is particularly clear for Treasury, because we can see in the market, the base rate, the interbank rates are changing, the Treasury's marginal cost of funds, the commercial risk spread, the liquidity charge, etc. These feed into our debit and credit interest rates in various forms, cash pooling as well, for example, even guarantee fees. Also, the credit ratings of the borrowers in our group, and indeed the guarantors, are declining and affecting pricing. And everything that Treasury does is affected right through to cash pooling and captive insurance and so on. And it may well be that within cash pooling, we shall have to recharacterize, have to treat cash pool debit balances as loans and remove them from the cash pool. Now, moving on, there is some good news about this, which is that individual jurisdictions have formally softened their transfer pricing approach, giving more time to provide transfer pricing documentation, for example, more time to resolve controversy. There's no explicit response in that way from the Luxembourg Tax Administration that I'm aware of, but we can expect these generic considerations to apply given the limited resource available to the LTA. Then moving on to the next slide, this is moving away from the crisis to the new financial transfer pricing guidance. Let us summarize it, because we have to accommodate this new guidance as well as anticipating the new guidance on crisis transfer pricing when we change our Treasury transfer prices now. So this is a wide-ranging set of changes, starting with more scope to treat loans as equity, following on from the long-standing IRS approach, and the guidance sets out a series of features of loans, such as date to repay the loan and some kind of interest, for example. A checklist which we have to consider when drafting our related party agreements. The new guidance accepts the principle of an arm's length amount of debt. Gearing, loan to value, perhaps. And it explains how that might be evaluated. But again, a new limitation on interest deductions. It requires a two-sided approach that was introduced for intangibles. The loan, if it is a loan, must make sense for both parties, including the terms and conditions. We look at the Chevron case. Would you have borrowed in an expensive currency, for example? Would you borrow for a far longer period at a higher interest rate than the short-term requirement you actually have? So we must ask ourselves, do we really need a loan that looks exactly like that? The guidance critically reviews at some length guarantees, cash pooling, and captive insurance and reinsurance. These have been the subject of substantial case law around the world for many years. And now at last the OECD is seizing this. It's up to us to prove that our guarantees, our cash pool headers, and our captive insurers add value. And that is difficult in the crisis because they're adding less and less value right now. Is the answer to have a temporary policy for review on January the 1st next year, for example. The guidance gives detailed instructions for loan pricing, pricing guarantees, captive insurance, not cash pooling, for example, or indeed debt factoring. The good news is that the detailed guidance is what we're already doing in the market. We don't always do everything it says in the guidance, but there seems to be more pressure to provide a thorough study now. And so this creates an expectation of more extensive transfer pricing reports, which is difficult now, isn't it? Because what we're doing may well be temporary and not worth doing something extensive about. So we are going to mention later in the presentation some possible shortcuts. Now moving on to the next slide. How can we adjust our transfer pricing policies for the new financial transfer pricing guidelines? We can amend our existing agreements, for example, amend and restate our loan agreements, perhaps with more loan-like features, with different terms and conditions which won't be challenged, different interest rates could. We can consider whether our new drawdowns on facilities, for example, are in line with the arm's length amount of debt, which could be pretty small at the moment. We are told to always calculate the effect of implicit support when it's doing credit ratings, not just the numbers calculation, but a bit more of the qualitative calculation. Fortunately, there are some grids to read off without too much work from the ratings agencies to do this. And we must take a two-sided approach, particularly to the pricing of guarantee fees. Traditionally, we look at the interest saving to the borrower, but there's another way of looking at it, which is how much does the guarantor stand to lose, and what is the return on the equity that it stands to lose. For cash pooling, we really need to work hard to show why the cash pool leader or header deserves more than a simple cost plus service fee. And for captive insurance or reinsurance, we need to show that the captives bear risk, already the risk, that they can manage the risk, and that their reward as a percentage of their equity, for example, is an arm's length one, and that is an arm's length reward on the actual amount of equity they need for their risk. This is all based on case law, such as DSU retail in the UK. And there's a general skepticism about group treasury, which is bizarre, given what we know about group treasury, that it is a simple service centre with the head office making all the strategic financial decisions for the group. And we need to explain the complexity of the treasury function generally. Doesn't assume that it's a given with tax inspectors. So that's the end of that overview. I want to hand over to Alain now to talk a bit more in detail about delineation.
Yes. So one of the first one of the first novelties of the new transfer pricing guidance on financial instruments is, in fact, the qualification of the purported debt instrument. And here on slide number 12, you see for the first time the OECD basically gives a list of what they call key indicators that have to be used in order to qualify a purported debt instrument as indeed debt or equity. So some are only referred to in the terms and conditions of the instrument, such as a fixed repayment date, the obligation to pay interest, the financial covenants, securities that are given that need to be market standard. and others are on the context. So there's the ability of the borrower to obtain loans from unrelated lending institutions. So that's referring to the options realistically available. What's the lender profile status, the right to enforce principal interest, and the source of payments. So those are the key indicators that are mentioned by the OECD. In discussions that we have had also with other Luxembourg professionals in transfer pricing, is that from a practical perspective, we believe that the most, or let's say the pillar indicator remains nonetheless the obligation to pay interest, which can cause an issue because in Luxembourg we use very often interest-free loans. They are very convenient in terms of minimum formalistics. The foreign shareholder simply finances the Luxembourg company by an interest-free loan. You don't need to worry about interest rates, about withholding taxes or whatsoever. You don't need to go in front of a notary. You don't need to do any specific formalities when you reimburse the loan. So it was used very much in Luxembourg. And this seems to create an issue now because if you would have then an interest-free loan and the absence of interest being the key indicator of an equity instrument, well then for corporate income tax purposes you would requalify your instrument as equity, meaning that if you reimburse it, it would tax-wise most likely be requalified as a reimbursement of fiscal equity, which may be subject to withholding tax as a share capital reduction in the presence of accumulated profits, for example. We also came to the conclusion that notwithstanding a potential requalification, there could not be a requalification from a legal perspective for Luxembourg net worth tax purposes. As you know, unfortunately, Luxembourg still levies a net worth tax of 0.5% of the company's net assets on each of 1st of January. But the net worth tax is foreseen by our net worth tax law, which is completed by the valuation law, which basically gives the provisions on how you need to evaluate the assets of the company. And in the valuation law, you will find a provision that deals already with interest-free loans and where you have basically to impute an interest of 5% per year on such a loan for specifically net wealth tax purposes. And from a legal perspective, under Luxembourg, under the hierarchy of norms, a Luxembourg law, a provision of law, cannot be overridden by OECD guidelines, which are by definition only soft law or a guidance that tax authorities should use when they interpret the OECD transfer pricing guidelines. So that's a little bit our feeling that even if there would be a requalification because there is no obligation to pay any interest, this requalification could legally not apply for net worth tax. So that is the most important one in the terms and conditions. I think the fixed repayment date should be fine. In practice, it's not much. It doesn't represent too many difficulties to foresee a fixed repayment date, and I think it's not unconceivable with an early repayment on demand, so it can be structured flexibly. The financial covenants and security should be market standard. So very often in intra-group loans, obviously you don't have any covenants or security whatsoever because it's kind of implicit if the parent company lends money to an affiliate that he will make sure that the money will be reimbursed or not, as the case may be. But here I think it's important to make sure that the documentation, the legal documentation, is actually proper drafted and is comparable to what happens between unrelated parties. On the context now, the options realistically available are quite nasty because those basically oblige the borrower to analyze what other means would he have had to get any funding? And if the outcome, or if the response to that question would be that would be none, so no unrelated potential lender would agree to lend this particular company any funds, well, then this is the argument to say that what the shareholder has actually granted to the company is not a loan, but it is equity. In practice, I think there must be an analysis included in this respect in the transfer pricing documentation. So in the transfer pricing report, there should be an explanation what other routes have been explored and why this financing in particular has been retained by the company. And this, of course, requires from those that prepare the transfer pricing documentation that they do have this information, because there must be then a higher input from basically the client or from the group treasurer who needs to communicate on this so that this can be correctly reflected in the transfer pricing documentation. The lender profile or status, this is a criteria which is not described in much detail by the guidance, but we believe it is referring to the fact that the lender should be an entity that is comparable to a professional lender, as opposed to a lender that would be more passive, holding company style shareholder. So if you would have a lender that is, for example, an investment fund, but it would be a debt fund that invests all the time in loans, that grants loans, that purchases loans, enforces loans, and there is a certain infrastructure to do this, there is a certain experience, you've got some human resources, you've got some other resources, financial resources to do this, well, that would be the criteria to say, well, look, the lender is comparable to a professional lender, and hence the instrument by which the lender has funded the borrower is indeed a genuine loan agreement. The right to enforce payment of principal and interest is I think, taken from case law. So the lender must, of course, have the right to enforce the payment, should also enforce the payment or make everything possible to get the payment of the principal and the interest. Because if a lender would not do that, well, why could you say that it's comparable to a professional lender? A professional lender on a free market would always enforce the payment of the principal and the interest. So to some extent, that makes sense. But the issue in Luxembourg is more that you should have, again, a proper documentation on the loan agreement where you do not have any provisions, let's say, that you don't find in the open market, like a limited recourse. A bank would never lend money under a limited recourse clause, or a renunciation clause, or anything that would tend towards an automatic waiver in certain circumstances. So absolutely no contingency. And well, as you know, Luxembourg used to use a lot of hybrid financial instruments where those clauses were more or less plain vanilla, and they were always used to give this hybridity. Those times seem to be over, but in practice, I don't think that the transfer pricing guidelines changed that much, because you have other pieces of legislation, and I'm thinking about ATEL, ATEL 1, ATEL 2, and so on, that would anyway render those kind of instruments and structurings impossible. And the last one is the source of the interest payments, the type of towards the types of efforts funded by the loan. So this is more a criteria whereby you should make sure that cash flow from the underlying investment allows the borrower to reimburse the principal amount and repay or pay interest as it is foreseen by the loan. If you would have the case where a loan is granted, but from the outset you see that the borrower could never repay the principal amount or could never settle any interest on that loan, because simply the cash flow from the underlying asset is not the same in terms of timing, well, then you would say, again, that is not a genuine loan because no lender would agree to that. So that would then qualify as an equity investment. I think I hand it over to Danny to move on with further input on this.
Thank you, Alan. So on the next slide, when can different terms and conditions of a loan agreement be imputed? There are two situations. If there is a better option realistically available to the borrower, or a better option for the lender. And for the borrower in particular, that could often mean borrowing with offering a security, agreeing to financial ratio covenants, borrowing for a shorter period, and borrowing without all those helpful options such as prepayment without a penalty, and so on. In other words, to make the agreements look more like arm's length loan agreements. And for the lender, we can imagine that the options available are more limited. This is a related party lender, for example, not a bank. But still, the principle has to be applied. And then turning to the next slide, the arm's length amount of debt. And there are three broad points to make here. The first is that we can consider the maximum amount of debt which lenders are prepared to provide, clearly requiring an analysis of the ability to repay principal in the long term and to keep up with the interest payments in the short term. And this would require an analysis of default rate, an expected loss and required return on this amount of equity compared with the expected interest payments. And then we look at the could versus would test, the headroom concept, which has long been there in HMRC's transfer pricing guidelines. What headroom would the borrower like to leave sufficient liquidity to maintain a minimum target credit rating, could it be linked to the cost or value of the asset which the loan is being taken out to acquire? For example, real estate. You might be offered a larger loan, but if the property costs less than you want to buy, why would you take out a much larger loan? And as well as those lender and borrower perspectives, we can look at actual loan agreements in the marketplace at the maximum gearing and the minimum interest cover, which we see in the financial ratio covenants of independent agreements, relative agreements, which sadly is not done as often as it should be. And the next slide addresses the calculation of the arm's length interest rate. Again, all using the new guidance here. It says that borrower-specific credit rating should be calculated based on quantitative and qualitative factors after an implicit group support adjustment, which is controversial in some jurisdictions. This should then be adjusted to calculate the credit rating for the specific financial instrument. We recognise that related parties do not usually charge loan arrangement and administration fees, and if we're benchmarking using arm's length interest rates, perhaps we should adjust for that. Perhaps we should adjust the related party interest rates upward. Where a loan is borrowed from an unrelated party to be passed on to a related party, the guidance allows for the original interest rate to be used plus administration costs, plus a risk premium, and a profit element. If only agency functions are performed, though, with no real risk, then the policy should be a markup on service costs. And there is an explicit warning about credit default swaps, which are sometimes used to benchmark interest rates. It warns that the volume of trades for credit default swaps can vary, and when it's low, there is an illiquidity premium which increases the price, and therefore it advises against using credit default swaps. Now, moving on, the guidance on financial guarantees. There's no guidance on performance guarantees at this stage, by the way. The four main points here are accurate delineation. Does the guarantee agreement say that it's legally enforceable? Does the guarantor have the financial capacity to meet its obligations? Will the guarantor also default if the borrower defaults? Are they in fact in the same industry and the same line of business? If they're likely both to default at the same time, is the guarantee worth anything? Well, if a bank has taken the guarantee, then perhaps it is worth something. What is the benefit to the borrower? And the maximum fee that would be paid because of the better credit rating, or simply because of expanding the pool of funds available to service the loan. Thirdly, what is the expected cost and required return for the guarantor, which produces the minimum fee. And then, going back to principles of competition economics introduced in the DSG retail case in the UK 10 years ago, 12 years ago, where would we be in that range between the minimum fee and the maximum fee based on the relative bargaining power? And we have to look there at competition economics principles, but the range could be very large for a guarantee fee. Next slide is a bit of light relief for everybody late in the day in the presentation. The EU, conscious that governments are advancing loans and providing bank guarantees for large, often very large national champion companies, has produced effectively this brief of minimum charges that should be made for loans and guarantees based on maturity and for some reason size of the borrower. I'm quite sure how that works. It has been suggested this could be a shortcut. We are looking perhaps at temporary changes in policies for lending and guarantees. Clearly some science has gone into this at the European Commission level. Could we just adopt these policies as a shortcut and say, well, don't penalise us, at least it's good enough for the European Commission? I know, Alan, you're rather sceptical.
Yeah, absolutely. I think it's quite strange that you have on the one hand side the OECD that publishes new guidance on transfer pricing principles for financial instruments, whereby it says clearly that there are no more safe harbors. So no more debt to equity ratios, no more interest rate safe harbors, no more lump sum valuations of anything, and so on. Everything has to be duly researched, documented, compared. But on the other hand, then the European Commission decides that, well, in order to simplify things during the crisis, let's foresee some lump sum interest rates or minimum interest rates that can be used for public lending without any difference whether it's the German government that lends or if it's the Greek government that lends. It's just the same for everyone to simplify. So again, there you see the two approaches, the two sides, the OECD on one side, European Commission on the other side, which makes it even more complex for the taxpayer to deal with these kind of issues. But I would be extremely prudent if we're not in the context of a public lending to use those lump sum interest rates in private companies. And I don't think that tax authorities are bound by this because you will have a lot of differentiating factors. And if you follow the OECD guidelines, you need to delineate the transaction accurately. And if you do that, then they will always have, let's say, the possibility to claim that your transaction is not comparable to the transactions that are covered by the European Commission's safe harbor rules. So I would be extremely prudent and would not rely on this between private companies.
Thank you, Alan. If we move on, we will quickly cover cash pooling and captive insurance, which there is quite a lot of discussion in this guidance, but worth looking at in detail, and also in conjunction with the 2010 Attribution of Profit to Permanent Establishments OECD report, which is referred to in this transfer pricing guidelines, which gives us a lot more detail for our functional analysis. So for cash pooling, delineation and pricing, I've mentioned hostility to the cash pool leader model, which is receiving a margin. And it says that should only be done if the cash pool leader controls and bears liquidity risk and credit risk. And the relevant questions are, does your cash pool leader bear the risk from the mismatch between maturity of credit and debit balances, and does it bear the risk of cash pool members being unable to repay what they have borrowed? And then I move down to the point about synergy benefits. The guidance says that the interest rates, credit and debit balance interest rates, should be set scientifically in such a way as to allocate the benefits of cash pooling between the participants. And that should take into consideration the relative bargaining power of the cash pool participants, which has implicitly been considered in the case law, for example, by allocating larger interest rates, the credit interest rates, to companies with more assets, with bigger positive balances, with better credit ratings, as if they're providing a guarantee. But unfortunately, the guidance doesn't tell you how to do the allocation. It gives you some very, very high-level principles, but it's not going to end the disputes. And hang on, I'll move on quickly to the next slide on captive insurance and reinsurance delineation. General skepticism, accurate delineation requires in particular that the risks must exist and that the captive must face a real possibility of loss, which sadly is often not the case. The captive must be able to diversify and pool the risk. That's very difficult, isn't it? If the captive has been set up to seek cheaper insurance on the market for the group operating companies, that's all making the same thing, and it only insures the group operating companies, how on earth can it pool its risk in a meaningful way? It would now have to take on third-party business, as suggested by the guidance. And it must have the necessary skills and experience, whereas in practice this is all normally all contracted out to one of the brokers. And then pricing of captive insurance and reinsurance. There's a lot of detail here, but the essence of it is that this can either be done in terms of setting the premiums. They should be set to cover the expected losses on claims, that you have to keep calculating in an actuarial way, the administrative costs and return on capital. But the guidance says that's complicated. Perhaps it's better to look at the overall profitability of the captive. That should be a return on equity only in terms of the equity that's needed to cover the risk, which after your more thorough functional analysis you may have found out is much less than you had thought. So those are the main points there on that slide. And now summary of recommendations, starting with the crisis. We suggest that you submit a response to the OECD review. They're very keen to hear. They're probably not hearing enough about Treasury issues at the moment. It's all about retail suffering, isn't it, for example, and the hospitality sector. But given the new transfer pricing guidelines for treasurers, as well as the crisis, we really have some issues, and we presume they were looking for some kind of allowance to simplify things in for a short term. change transfer pricing policies of independent parties would do so, pay compensation where due, prepare amended agreements, amendments which say this is a temporary measure for the time being, and prepare some very brief documentation just to say we have changed the policy because, and it's temporary. If you have to do new benchmarking, consider using some different benchmarks. And if you are having to prepare your annual transfer pricing country documentation, then you have to incorporate the COVID-19 situation in terms of government restrictions on trade, government support, and the general decline in sales that you're facing, and how that affects your profitability temporarily. And finally, a summary, recommendations, a longer summary for responding to the new financial transfer pricing guidance. New loan agreements should have arm's length features, as Alan has discussed in the Luxembourg context, problematic for Luxembourg. Research should be documented to confirm the feasible amount of debt, should and would. The commercial rationality of loan terms and conditions should be explained, or they should be changed. Interest rates should be consistent with the results of a quantitative and qualitative credit rating, taking into account implicit support. Guarantee fees should respect both perspectives, not just the traditional borrower's perspective. And in theory, they should also consider the relative bargaining power of the guarantor and the borrower. And there's no guidance on that. Cash pool leaders are under great pressure to show that they have important risk management responsibilities, and the synergy benefits of cash pool participants must be allocated scientifically. Both credit and debit balance interest rates will be relevant, but we don't know how to do that. And captive insurance companies must be shown to have the ability to pool uncorrelated risks for a large number of policyholders, which does suggest that we may have to find more people to insure, not all of them related. And finally, the in-house banking function of a Treasury company must be documented carefully, and its responsibility of setting group Treasury policies. Given that point I mentioned, that you may have, say, a Luxembourg Treasury company, but the solution may be that at head office somewhere else in the world, that is where the key financial decisions are being made. And with that, that is the end of the substance of our presentation.
Now maybe it's time for question. First question for you, Danny. What are the long-term implications of changing transfer prices generally during this crisis?
Well, I think the point I made was that there could be long-term or short-term consequences. If you want a change, you probably want the change to be short-term, then say it's a short-term one for review, say at the beginning of next year. We have to remember that there are a lot of companies in a group traditionally which are meant to be low risk. If we now ask them to share the financial pain, they at least temporarily cease to be low risk. We have to say that that's temporary, if that is right. But even when we go back to the old policy, they're low risk, they're low risk. In fact, we've shown by changing the policy now that they're not as low risk as we said they were, because there are situations once every 10 years perhaps when they will be asked to give up a lot of profit. And so perhaps we should give them a higher reward for the next 9 years in between. And we also have to think about compensation. If there's a long-term change, a shift of customers, for example, between companies.
Okay, thank you. So a question for you, Alain. How can a company manage a new TP uncertainties in a particular jurisdiction?
That's a very good question. Unfortunately, there is no clear-cut answer to this. There are indeed a lot of uncertainties in the new transfer pricing guidance, and there are also uncertainties on the adjustments due to be made under the COVID crisis. But again, I think transfer pricing is not an exact science, and it's not. We don't have a black or white situation here. I see it more as a gray area, and my recommendation would be to invest into the quality of the transfer pricing documentation. The better your documentation is, the more points you have addressed in the documentation that are required by the new guidance, the more you have explained why this or this option has been taken, and there is a certain rationale behind the choices of the company. The better your transfer pricing documentation is, the more robust it will be as well, be it when you present it to the tax authorities, or if you have to present it in front of a judge. This being said, that there are countries that provide for the possibilities of an advanced pricing agreement, such as Luxembourg. So think also of this possibility. If you have time, which unfortunately is not very often the case, but if you do have time, and if your jurisdiction foresees the procedure of an APA, well, why not do that? Although unilateral APAs have only a limited security, I would say, because then you know how it's treated in this country, be it the country of the lender or of the borrower, but still you don't know how it's going to be treated in the other countries. So if you go for an APA, most often a bilateral APA makes more sense, but this is much more time consuming. So again, I think the most important thing is to have a good transfer pricing documentation. The better the quality of the documentation, the more robust it is in case of a liquidation. So that would be my advice, and as one says, prepare for the worst and hope for the best.
Yeah, so it's a good takeaway for our audience. So be prepared and don't wait for the control to compile your documentation. So maybe another question for you, Anna. When does this new financial guidance start to apply?
Yeah, that's a question that has been raised several times by clients. Well, first of all, the OECD guidance is what we call soft law. So it's not per se a legal basis that it would need to be implemented into Luxembourg law. But nonetheless, it is used by the Luxembourg tax authorities rightfully, as by all the tax authorities, I guess, of the OECD member states, when they give an interpretation on the OECD guidelines. And the OECD typically adopts a dynamic approach, and it starts from the principle to say that, well, whenever we change the guidelines, it's only a precisions, basically, that we give on the existing guidance. So it should also be applied for the past, when tax authorities look at today at situations from the past. But with the new transfer pricing guidance on financial transaction, this logic cannot work and cannot be true, because this guidance is completely new. This is a new chapter in the transfer pricing guidelines, and it has not been addressed anywhere before. So we believe that you cannot reasonably argue that it should be applied to past situations. Nonetheless, under the dynamic approach, it seems that the OECD and most tax authorities, however, say that when we will, in a couple of years down the road, assess the tax of local taxpayers in order to give an interpretation on the OECD guidelines, they will, for the future, they will look into this guidance. So my recommendation would be to review your current transfer pricing documentations. If they are not in line with the new guidance, well then it's difficult to do anything within the current year. But make sure that for the next opening balance sheet, you have your transfer pricing in compliance.
At least this guidance gives us a better view on what we should do and how to interpret the rule and the actions. So maybe the last question for you, Danny. Is it possible to shift the tax risk associated arising from tax administration disagreeing with the transfer pricing policy for loans?
Well, clearly the risk must have increased with the new guidance. It's taken challenges across the world from big disputes and mention them all to the tax officials. So they should all be considered, and we should be asked to answer all of these challenges. The tax risk associated with loans have traditionally been addressed through warranties and indemnities in M&A transactions provided by the vendor. We understand now that in fact there is a market for insurance for loans, related party loan tax risks, with premiums starting at 2% of the anticipated or maximum tax liability, which has to be confirmed by the broker with their transfer pricing report. Given the new guidance, which talks about the two sides, we could expect insurance also to become available for the borrower and the imputation of additional tax based on a higher interest rate perhaps they should have charged. Thank you.
Thanks a lot for this presentation, comprehensive presentation on the new guidance, very useful, and also on the impact of COVID-19 because it's also exceptional situation. So thanks to both Alain and Daniel for this interesting presentation.
Thank you very much.
Thank you, Francois.
Thanks a lot. Thanks to all the speakers. So any other further questions so, from the audience? So don't hesitate to send a question. In any case, if you have any question, you can send us a mail and we will make sure that the speakers will answer to your question. But maybe if there is no question, so let's start with the first one we already received. So maybe a question for Jörg. Jörg, you're still online. You hear me? Okay. So
I can hear you and I can see you.
Okay, at least. No, first question, I hope that you can hear me. So a question we received. So you know that the customer security program from SWIFT is quite heavy and quite expensive for corporate treasurers if they want to have a direct connection. So passing by your solution by TIS, could they, by outsourcing, getting rid of part or maybe totally the internal controls imposed by SWIFT?
Yes. So here we have good news. Yes, next to those host-to-host connections, which we have established with the banks and EBICs and these things, we can leverage the SWIFT network. We are a SWIFT partner, certified SWIFT partner. And from a treasurer perspective, there is, you keep it simple, yeah, that's best case. You outsource everything to your service provider. And that's the case here. We run your line-slide toolboxes on your behalf, and in a nutshell, that's a kind of SWIFT as a service. And back to your question, yes, there are additional administrative burdens attached to it. And here we have a new offering in our pipe where we will take over a large portion of that compliance topic, of that admin burden also to us. I mean, we have the experience and we can leverage that experience with our own colleagues on behalf of the customer to make the treasurer's life easier at the end.
Yeah. So good news. It will ease the connectivity with banks and save time, money, and again, get rid of part of the control. So excellent news. Okay, so maybe another question we received for Philippe from PricewaterhouseCoopers. So as we mentioned during this crisis, we've noticed that a lot of corporate treasurers were over abusing of Excel spreadsheets, especially for special demand from the C-level. I'm thinking about the stress testing and the sensitivity analysis, and of course, cash flow forecasting. So Philippe, a question for you. What could you say about cash flow forecasting? What are the situation of your customers? Any comment, any tips you can give to our audience?
Yeah, thank you, Francois, for the question.
Well, I think we have a lot of different scenarios. Indeed, we have people with no dedicated tool for cash flow forecasting, and then we have some companies with AI and a lot of tool well, a lot exists on the market, by the way. But if I can give one advice, I say even if you have no tool and if you have, I mean, somehow worst case never done any cash flow forecasting, it's more than time to do it, because I think Pareto is very helpful. Spreadsheets can be fine. You just need to concentrate maybe on the significant flows in and out, and then try to stress a bit your situation. So you start with your level of cash. You see what are the big income, the big outcome, and then where do you need some liquidity assistance somehow. And then if you have the budget, if you successfully negotiated with your CEO or the board or whatever, then you can try to to build a business case. I think you have good argument now to show how important it can be, and you have state-of-the-art expensive solutions, but you have as well some cheap one which are working quite well, if I can say so.
Thanks a lot, Philippe. So in order to respect our timing and to move, and before moving to the networking session, so I would like again to thank our let's say 6 speakers and 4 sponsors, so Arendt, TRS, PwC, and of course HSBC, because we were hosted by HSBC Luxembourg today. So thanks a lot for all this. I hope that we will see you, or at least have you online for the next conference. Our next conference will be in September, the annual conference of ATEL. And so it will be partly physical conference and partly an e-conference. So we will certainly improve again, and just to make sure that we will offer you the best content as always, and the best quality of broadcasting, to make sure that you will be pleased by our conference given the circumstances we are facing today. Of course, we hope to be able all very soon to come back to a normal physical conference. So thanks a lot for your time, for your attention. Thanks a lot for sharing with us this interesting presentation. And now I would like to conclude and to close this conference. But for those who want to stay with the 2 networking sessions we've organized, feel free to join us. Have a good evening. Thank you.
Thank you. Bye-bye for now.
Et qu'on se couche ici. Okay. So, do we have any question for my networking session? A session we organize together with TIS and PwC. So Jörg is still online and Philippe is still there. So, any question? Okay. Okay. Or Jörg, any comment, additional comments? So we can start and we will see if people are joining. You're on mute, Jörg?
No, I'm not on mute now. Thank you for letting me know.
We're waiting for the first question. Any comments? So, because really, I see a clear trend, and the topic we would like to address in this networking session, it's to talk about outsourcing and again, how to, let's say, draw some lessons and some consequences of this crisis. And as mentioned at our first presentation with Philippe, I think that it's a good boost, an opportunity to sell project and digitization project like your product, so for having a payment factory, because a couple of answers could be automation, centralization, and certainly getting the right tools compared to the tool we mentioned. We still have a lot of people having a paper process for payment. So what are your views? So any comment on that?
Yeah, life is getting easier and easier for treasurers, and there's one big trend. I mean, when we started this business 10 years ago, cloud was in the early stage, and now cloud is mainstream, as I said already. And We are proud to see that this vision became true. We believe the next big thing is best of breed plus API. And this makes the life of a treasurer much easier because there is a certain challenge, a certain pattern of problems, and you can choose providers which are specialized, best of breed providers to fix this problem. So you don't need to run through a complex ERP system or through a treasury system if you have a specific challenge in payments or in cash forecasting or in hedge accounting or in, yeah. So the best of breed application providers, they can connect to each other easily connect to each other through these APIs. Yeah? And that's the game changer, and that's the reason why integration between those systems is not a big topic anymore. And this is good news here, because with those best of breeds, you are much faster. Yeah. And yeah, that's the new trend which we see in the market. And best of breed, nobody like Decathlon, right? Nobody is good everywhere, and we believe it's a good idea to combine those heroes or best of breed applications for you.
Oh, I completely agree. And before asking Philippe to comment, so it's what we've noticed at the EACT level across Europe. A lot of corporate treasurers prefer to go to the best of breed and to find the best solution for a specific need. And you can be the case, for example, on payments. So rather than as a global application that could be used for every single use, because as you said, no tool could answer all the requirement expectation of corporate treasurers. So I think that it could be a combination of solutions. I fully agree, and especially with the evolution of the technology, the evolution of the new SaaS version of TMS, because now with the solution, it's very generic and it's not fitting all the needs and specifications of our members. So we've noticed that, and certainly it's a trend that will increase in the future, as you say, technology is there. So Philippe, any comment, view on that from your customers?
Yeah, I think I can just agree with what have been said. Maybe some additional things. You mentioned SaaS, so it's true that systems as a service is really there to help you to increase your control and decrease the cost, I would say, compared to a classic big ERP implementation. And Jörg, you were mentioning hedge accounting, and it's true that we see more and more corporates where the day-to-day hedging for classic FX, for instance, is really automated from A to Z, which allows treasurers somehow to spend more time and to think about strategic hedging, big deal forecasted, or hedging future acquisition and stuff like that. So yes, somehow the life is becoming easier, and this is compensated by the fact that we are asked to do more and more and be somehow a bit more the strategic advisor for the corporate. So yeah, that's it. Somehow.
Yeah, no. To continue on that topic. So I have the impression that a lot of us were using more and more Excel because of the urgent demand from the C-level. So they were trying to produce a report to answer the key question. And we mentioned sensitivity analysis, stress testing, this kind of cash flow forecasting, etc. And it's a sort of paradox of the current situation. So technologies have never been so developed and so fast to offer a solution. And at the same time, we use Excel. But it's also linked to the fact that our systems are fragmented. We don't have one single system capable to answer all the need. And so having a quite complex IT architecture, it's difficult to make sure that you can have all the systems talking to each other. We have different formats, and that's one of the issues. I don't know if you've noticed that, Jörg, but I guess it's an issue you have certainly discussed with your customers frequently.
Yes, I mean, that's clear. Excel is still part of the game. Best case is when you can offer your CFO kind of self-service dashboard where he can answer his questions very user-friendly through own dashboarding, best case, even available on his mobile device on a daily basis, real-time cash positioning and he can drill down through certain filters and analyze the cash flows. That's best practice. Self-service CFO, which frees up resources in the treasury team, and to avoid these Excel jogging topics. And you mentioned that you need one single source of truth or something. Here, a best of breed is also the answer, because give you an easy example. We have partners on the cash forecasting side. Yeah, you need for professional cash forecasting, you need a rock solid cash position. You need to have clean actuals, and this actual data can be pulled out of our database into the cash forecasting tool through these APIs. So we talk to each other from a technical perspective, and you don't need to have these Excel spreadsheets in between your systems to feed those systems. This can be automated through APIs.
Absolutely. Again, for those who join the session, so please you can unmute and you can engage a conversation. Just mention you're there, and so raise your question, Penny. No, but it's interesting to see that, and again, API is also another interesting trend we have noticed, and we are pleased with the PSD2 and the open banking. And it reminds me of a discussion I had recently with some of bankers, and bankers see also the benefit of PSD2 after being complaining about the open banking. Now they realize that it could bring the cash management and trade finance, but also sector of the bank, to the next level, and to offer additional services to the customers. So if we, the three of us, technology, fintech, corporates and banks work together, I think that we can improve the situation. I don't know, Philippe, any comment on the trends and what you see?
Yeah, I think you forgot consulting in your list.
Sorry,
we working together. except I would say, joke aside, we've been talking here a lot about best of breed and so on. But I think before engaging in such project and going for so much sophistication, what is really key is your data. And I've seen a lot of corporates who we just engage in big project and it was just a failure, because you can have the best technology you want, but if you do not ensure first of all data quality and data integrity, it will never work. And I think this is something key that we need to repeat it again and again, because the starting point, I think, is really cleaning your data.
Yeah, and maybe to add another comment, and something that we noticed during this COVID period, or in post-COVID period, the trend on the treasury on demand is really emerging, and a lot of corporates are asking for having real-time information. And of course, as you mentioned, the better the connectivity, the better the, let's say, interface and straight-through process with the different system, the more, let's say, a possibility you will have to upstream the information more quickly. And it's really a demand from the C-level to have a real-time treasury, what we call the treasury on demand. And the beauty is that technology is there, so I guess that it could bring us in the new stage or new age of corporate finance. So I don't know, what is your personal view on that?
Yeah, real-time is a big topic, and this is a very nice opportunity for the treasurer to shine, not only in front of his CFO, but also to support your lines of business. And yes, it's good that you have your real-time cash visibility available. Perfect. But it's even better to trigger supply chain activity. Like we have received the payment right now, 5 minutes ago, and we can immediately start to send out the goods to our clients. Think about this user experience, your customer experience. And here the treasurer is a business partner and is really capable to support your lines of businesses. And that's what, by the way, that's what the CFO expects from a treasurer. A successful treasurer is a business partner, leveraging that technology.
Yeah, before asking Philippe to comment, I completely agree. I think that we can partner with other departments horizontally, but also vertically with the affiliates. And it's a fantastic opportunity to be closer to our operations and to give a competitive advantage, because you mentioned instant payments, again, delivery, trade finance that could compensate the fact that, as Philippe mentioned, terms of payment are longer and longer. So I think that it's a combination of different solutions, but it opened doors to be closer to the operation, where usually the treasurer are a bit far from the operation. Philippe, any comment?
Yeah, short one. I think you say that the treasurers should help the business with the treasury on demand and instant payment and instant refund as well. I would say you have to, because the more different channel of payments you will add to your business as a whole, the more impact it will have on your treasury, on the way you will have to manage your working capital. So yes, treasurer has to be in there, and he has his words to say in order to make sure that everybody's aligned and everybody can monitor, follow up, and react if needed with those instant payments and refunds.
So I don't know if, because we have many participants still there, so if you have any question, feel free to unmute and to raise a question. But if not, Jörg, we talk about payment connectivity, but we should also talk, and it was mentioned several times today, bank fees. It's also quite important. And I would like to talk also about IBAN. What do you think, or BAM or IBAN? But we all hope in our dream that sooner or later it will be possible to exchange with the bank through the SWIFT channel. And I guess that TIS has certainly worked on these two important elements, especially where we try to reduce the cost.
Yes. So we were the first in the market based on the pain which I had with regards to bank account management. So we were 10 years ago, we were the first vendor in the market offering a bank account management solution. And this makes a lot of sense, because instead of managing your bank accounts in Excel, this is not audit proof. This is, with Excel, there is no collaboration possible. So we launched this bank account manager, and this was a great success. This tool helps you to create a full inventory of your bank accounts. So normally there are hundreds of bank accounts in many different countries, and successful bank account management is successful collaboration. And from a treasury perspective, there is a small treasury team typically, and you don't want to do all the work around bank account management and bank account administration. So you need to cascade work down into your subsidiaries, and this happens through workflows, and that's what we support. And the next step, so when you have your clean inventory and when you have your all the documents, by the way, also attached in our system to the bank accounts, including the signature cards and these things, and then you can start to calculate your business case for IBAN, electronic bank account management, where you send instructions to the bank. And here, if you have 200 bank accounts and you have a very, very low turnover of that bank account population, so you open maybe 5 bank accounts a year, yeah, then it's really hard to calculate a business case. Maybe this takes 5 hours per bank account, 25 hours times, difficult to justify. If you have 10, we have customers with 10,000 bank accounts and almost in 10 bank account new openings on a daily basis, then it makes a lot of sense. And then we discuss this IBAN scenario, but IBAN scenario in a shared data experience. So the data is there. Why do you need to transfer that data through an XML file to the bank instead of asking the bank to access your data, which is on our cloud platform? Much easier. You don't need to transport, and that's we call it IBAN 2.0 story, where you collaborate not only in-house, but you collaborate with your partners, for example, with your banks on that database.
Again, I like it because you can decentralize the input into the system.
Yes.
And you can, let's say, make sure that the owner of the bank account, the affiliate subsidiary, will do the maintenance of the bank account.
Yes.
YC, but you have one single repository with a single process and well-defined procedure and processes to make sure that at the end you have one global picture for all your bank accounts.
Yes.
And you know, many of our members who are unable to give you the full picture. They have a picture, but not the full picture at any moment in time. Moreover, even if you have 100 bank accounts or if you have 10,000, as you mentioned, it's an issue for us. So I think that it will be sort of interesting and again to secure more the flows between the bank and the corporate. Philippe, any comment on this connectivity and way for improving the connection with your bank or other topic you would like to address?
Yeah, well, I think maybe we have been signed out. I don't know whether you can hear me.
Yes.
Can you hear me? Yeah? Okay, good.
Yes.
No, just one thing. I think we've been talking about centralization and the central view, and I think that having that EBAM and all banks account in a central repository is exactly what people are looking for, because initially the dream was to have only one team dealing with everything, and nowadays we realize that this is just a dream. And for regulatory reason, for local business reason, we will always keep, I mean, for multinational at least, treasurers here and there in the world, but I think the idea of centralization is really that, is to have all data in the same place in order to enhance the control, to avoid fraud, and to have that vision, which, yeah, I think a lot of members are still looking for. So I just fully agree with you, Jörg.
I think it's true, and also when we have noticed during this post-COVID period, so a lot of people will realize that it's really important to be fully digitized. If not, then we have problem because it was fragmented, so it's difficult because the communication between your team members is not the same as when you are all in the same offices. But then it's quite important to make sure, and a lot of people have single problem, like a simple problem as not having a digital signature with some banks, so they were still using archaic way of communication. And I think that it could be a good opportunity to sell the project, and besides the cost cutting we saw on one side, maybe to offer possibilities to the corporate treasurer to sell to the C-level this kind of project. So I hope that given the circumstances and despite the cost cutting, we'll be able to have a good case study for selling the project. So maybe a final conclusion, Jörg, and then I propose to close. Any comment or ideas or things that you would like to add?
Yeah, I mean, recommendation is obviously leverage technology, make your life easier, and this allows you to focus on the really important topics. And this is not only about you, it's also about your team members. And there is a war for talents. It's really difficult to find talented treasury colleagues. And if you are capable to offer a position which is supported by technology, which has state-of-the-art technology, and your colleagues don't need to do this Excel jogging anymore, then you have also a competitive advantage.
I fully agree. We are chasing for talent. It's not easy. And so if you can come with more exciting job, more technological job, it will, and with more interesting added value tasks like analytics and strategic tasks, it could be also more attractive for the young generation and to make sure that you have the proper staffing of your team. So I propose to stay on that conclusion. I would like to thank you all, our two speakers, to joining me for this session. In any case, any questions, feel free to send to ATEL your question. We'll be really pleased to answer and to connect you to all our speakers. If you want further explanation, demo, or other things, you have specific question, you want to have an assessment of your current situation, how to modernize your treasury department. So I'm sure Philippe and Jörg will be pleased to give you some support. So thanks a lot for attending the conference. Thanks a lot for being patient for a couple of hours. I hope you will enjoy. And I just want to confirm that all the content, the videos, as well as the magazine will be soon, I guess on Monday. So thanks a lot. Have a nice evening and talk to you very soon.
Thank you, François.
Thank you.
Bye-bye.
François. Bye-bye for now. Take care. Stay safe.